Good day, and welcome to Wealth Matters. It is a pleasure for me to be here with all of you today. By now, we have all become very used to the concept of virtual events, and in many ways, they have become the standard for information sharing. Technology is a powerful driver of our business, and as we grow and change and see how technology can help us be more efficient. Recently, of course, the rise of artificial intelligence has definitely taken center stage. And here at Momentum Investments, we recognize that there is no substitute for the human touch. But we are always looking for ways to better deliver on our clients' expectations when we partner with technology. A bit like this.
Good morning, Fadi. It's great to finally meet you in the flesh.
Hey, Lucinia, likewise. I'm so pleased to see you today so I can hand over the NC responsibilities to you and I can sit back and watch the webinar.
Yes, it's so much easier when you can be part of the audience. By the way, do you think the audience will like my outfit, or do you think I should quickly change?
You know, Cinia, I think this audience, if anything, knows actually not to change too quickly. So I would say stay as you are and enjoy.
Hello, and welcome to my very first Wealth Matters webinar. I'm Sinia, your synthetic intelligence announcer. Though between us, I like to think of myself as your friendly digital host who never needs a coffee break. It's a pleasure to be with you this morning. Today, we are going to share some exciting updates, news, and tools as we look at bridging the worlds of technology, finance, and human ingenuity, an intersection point that is sometimes referred to as techmanity. Now, before we jump into our agenda, let's take care of some housekeeping. We've applied for continuous professional development, CPD points, for today's session. To ensure your attendance is recorded, please watch the entire webinar and submit your ID in the CPD section. Our platform will remain accessible until the end of April 2025, giving you plenty of time to revisit the content and secure your CPD points. For those who didn't know, we have some good news. CPD certificates are now automated. Once you've watched the full session, your certificates will be sent directly to your inbox. Efficiency, right? It's like having a personal assistant, minus the coffee runs. As always, please feel free to ask questions using the Q&A section. Our expert speakers will address them either in real time or after the session. Let's get started. To kick off our session, please welcome Himna Landman, CEO of Momentum Wealth, and Martins Barnard, a marketing actuary. They will be exploring how technology can solve advisor challenges, enhance efficiency, and strengthen the client value proposition. As we move closer and closer to this techmanity intersection, the ability to future-proof your business will be accentuated and enabled by technology. Over to you, Himna and Martins.
Thank you, Sonia. Good day, everyone. Thank you for the opportunity to be with you today and to share some thoughts on how you as financial advisors operating in the South African context today can leverage technology available to you to strengthen and differentiate your client value propositions and accelerate your business growth. My name is Himna Landman, CEO of Momentum Wealth, and with me today is our marketing actuary and expert, Martins Barnard. Business owners globally are challenged by increased competition and therefore client growth. This leads to pressure on profit margins, cost of acquisition, and of course, time and how to scale your businesses effectively. We won't have sufficient time to cover all these topics in detail today, but we would like to share some practical insights on how we believe you as financial advisors could leverage technology and fintech available to you to differentiate your value proposition by improving client outcomes and then accelerate your client retention and acquisition. Martins will be presenting on how to leverage data for personalized value propositions. He will share insights and practical examples based on data available on the Momentum Wealth platform and how predictive modeling can improve investor behavior, leading to improved outcomes, and he will share very interesting insights on how your clients' retirement outcomes could be improved. Let's now focus a bit more on some of your typical business challenges as financial advisors. Number one, time. Time is, of course, a scarce commodity today, scarcer than it has ever been. The question is whether you feel that you spend time on the most value-adding activities. And do you delegate sufficiently, not only to staff, but also to technology? Secondly, scalability. Do you believe that you operate through efficient infrastructure and simplified processes? And then lastly, client growth. How to beat the average and attract and retain more clients by strengthening your value proposition. Of course, all three of these are closely connected, and now Martins will focus on data and the client value proposition. Thank you, Martins.
Thank you, Nan Sinya. Hello, everyone. The saying goes, data is the new oil. But this is often misunderstood. The saying means that data, like oil, isn't useful in its raw state. It needs to be refined, processed, and turned into something useful. Its value lies in its potential, and this can even be more valuable than oil. One way in which Momentum Investments have processed and refined our data is by analyzing investor behavior, more specifically switching behavior. In the beginning of February, my colleague, the head of behavioral finance for Momentum Investments, Paul Nixon, again released the annual sci-fi report. The report highlights that in 2024, investors destroyed about 60 million rand in value through switching. And that is only in flexible investments and in living annuities, or as we call them, RIOs. The RIO clients that did a behavioral switch paid 4.26% in behavior tax. In part, this is because most of the unpopular funds from which they switched deliver up to a 14% better return in the next year, implying that what they should have done is something that is very difficult in investments, but what they should have done is nothing. They should have just resisted the switch edge. You will notice that a lot of the time, the points that I'm making here is based on living annuity data. Clients in RIOs pay a very high behavior tax, and this links nicely to my next agenda point of retirement. But to the point, I want to highlight a key finding from Paul's research. When building a predictive switching model, you can use a certain machine learning algorithm called a random forest. Now from this, you can learn which factors are the best predictors of behavior. It is very insightful to learn that some of the attributes that makes investors more likely to switch is firstly the size of the investment and the investor's age. Both of these factors are prevalent in living annuities. So what we're seeing here is not surprising. But let's first jump back into the sci-fi findings and try to answer the question, does every client who switches exhibit the same behavior? To answer this, a different data science algorithm was used. This time, an unsupervised machine learning algorithm that we call a clustering algorithm. Now, the main idea behind clustering is to find groups of investors with similar switching behavior. As a simplified example, imagine these dots represent investors who have switched plotted onto a two-dimensional map. And the position where each of these investors find themselves in is based on the factors surrounding their switch. Did they take on more risk when they switched, or did they take on less risk? What was the difference in the historic performance between the funds from which they switched to which they switched? And was there greed factors or fear factors when they did the switch? The clustering algorithm then sort these clients into groups. In this example, 3 groups that holds investors with similar behavior. For those of you who is interested, through math, the algorithm places these 3 red dots that you see there in the centers as far apart from each other as possible, while putting them as close as possible to each dot in every single cluster that's around them. When our data was run through the algorithm, we ended up with 4 clusters or 4 archetypes of investment personalities. Now they're listed here, and the first one from the bottom is the avoider. This investor personality tends to avoid risk, and switches are done between conservative portfolios. They tend to pay the least behavior tax. The anxious investor is driven by fear and tend to switch out of markets when markets are falling just to miss the recovery. The assertive investor are driven by the other factor that rules the world, greed. They chase past performance. And lastly, we have the market timer. They sort of suffer from the worst attributes of the anxious and the assertive investor. Market timers remain predictably irrational, paying the highest behavior tax at 5.92% as markets surged late in 2024. From the graph, we can see that in the past 5 years, in every year, all these archetypes paid behavior tax, except in 2022, when on average, only the assertive investors paid a behavior tax. There is still so much we can do in this field in order to minimize the switch edge to help investors. One of the things could be to do personalized reporting to nudge investors to stay on track. We are sure our existing research and future endeavors can help you improve your client value proposition. We also believe with the correct product design, we can limit the behavior tax, and we believe that we've already done so with the hybrid annuity by introducing the guaranteed annuity portfolio. So with that in mind, let's jump into the next section where we're going to talk about retirement outcomes. This section relates to how we use data to empower you by giving you access to advanced retirement planning technology. I've been using a case study for the last while now, and here we have Greg, a fictional client, and I'm going to use this to prove a point. As a new investor, Greg fits almost smack bang in the middle of our retirement client base. He's age 65 and is drawing an income of 7% per annum. For Greg to maintain a 5% escalation on his living annuity income to the age of 90, he would need a net return of 11.2% per annum. That is the plan. But what happens when long-term returns are just 1% less? Then Greg starts to run out of income at the age of 84. And if markets miss by only 2%, he starts to run out at the age of 81. Such a small underperformance also has a detrimental effect on his ability to leave a legacy. The question is, are these numbers even reasonable? That is, planning for a 11.2% return or tracking underperformance at 10% or 9% when we have not even mentioned which funds Greg are invested in. Is he invested in a property fund, a balance fund, or an international fund? And should Greg perhaps consider using a different type of investment component to try and counteract these risks, market risk and longevity risk? That is why we built the Income Illustrator. With the Income Illustrator, all existing and new clients can get a projection of what their investment could look like under conservative market conditions. A projection that takes our long-term economic views into account and that is based on the behavior of the asset allocation of their portfolios. As a side note, the first Excel model underlying the technology of the Income Illustrator used to run for about 14 hours to do the needed simulations. But by using technology, you can get a view of what could be in seconds. In addition, this model provides an alternative asset allocation whereby a section of the portfolio is allocated to our guaranteed annuity portfolio, essentially a life annuity. This allocation is done in a way to give you, as a financial advisor, a great starting point for the purposes of portfolio construction. The illustrator can do this as it has already considered thousands and thousands of potential allocations and simulations and compared them across various of the factors we consider to be important retirement metrics. That really gave insight to advisors to one of their most frequently asked questions. How much should I allocate towards the gap? In addition, the starting allocation is also influenced by your client's personal preferences in terms of his views of leaving a legacy or just focusing on income. But at the end of the day, we have made this investment in technology so that you are empowered. We want you to be empowered to personalize the advice that you plan to give. And with that, over to you, Imna.
Thank you, Martins, for showing us practical examples on how tech and data offer powerful tools for advisors to personalize client experience and to develop a differentiated value proposition. Data, no doubt, has power when it comes to personalization. In closing, I truly believe that financial advisors and platforms should collaborate more to embrace the power of data and information in our systems to optimize your client outcomes. As a business owner, identify the key aspects of your business which you believe need to be optimized, whether it's to create time, to grow your client base, to strengthen your value proposition, or to streamline your operations. Then consider technology that solves your specific pain points. You can take comfort in the fact that the leading LISPs or platform providers like Momentum Wealth are investing large sums of capital to ensure that we stay ahead of tech advances and always looking for ways in which we can offer these innovations to advisors who choose to partner with us. Then remember the balance. Leverage your own capabilities and integrate with technology that complement your own strengths. I would then like to end with the last slide. Grant me the serenity to accept what computers can do better than people, the courage to let people do what they can do better than computers, and the wisdom to know the difference. Thank you very much.
Thank you, Himna and Martins. It's inspiring to see how platform providers are collaborating with advisors and investing in technology to stay ahead. Proof that even in finance, standing still is not an option, much like keeping your Wi-Fi connection stable. Next, we have Ray Mere, CEO of Curate Investments, to share how Curate helps you navigate the asset management landscape for your clients. Their approach aims to provide simplicity by scouring the globe to find the best people to manage your clients' money, allowing you to focus on what matters most. The partnership they offer lies in the art of investing, and we are looking forward to hearing all about it. Welcome, Ray. We're all ears.
Thanks, Sinia, and good day, everyone. Welcome to Curate Investments presentation. What does it mean to curate? To curate means two things in our minds. One is to take care of something important. Two is to put together some of the best things and put them on display for people to see. This resonates very well with what we do, hence the name Curate. What do? We handpick the best people to take care of your money. Now, what does that mean? Unlike other asset managers, we don't manage the money ourselves. We go out and find the best investment managers from all over the world to come in and insource them to manage our clients' money. How do we do that? When we looked at launching the business, we came up with some guiding principles that we wanted to follow to create this business. One, we wanted to have a global reach. Two, simplicity is key. Three, excellence and performance, making sure that we add value to clients. 4, exclusivity, and 5, relevance. All of these things are very important to our business, and I'm going to touch on every single one of them now. So let's talk about global reach. We've selected investment managers from all over the world. 2 from the United States in Boston and New York, 1 from Oxford in the UK, and 1 from Rotterdam in the Netherlands, and then obviously the investment managers here in South Africa. Not only are we selected global managers, we also distribute our funds globally. Our funds can be found in South Africa, Middle East, Southeast Asia, and Latin America. That's what it means to be a global business. Now let's look at simplicity. If you look at the South African unit trust industry, there's close to 2,000 unit trust funds available to you and your clients. If you look globally, it's even worse. Over 140,000 funds available to you and your clients. Our job at Curate is to simplify and refine that choice. What do we mean by that? We want to go and select the right investment managers for the mandates that we believe you and your clients need. We are committed to finding those gems for you. The managers we've selected must be top performers, individuals with the highest integrity, and committed to delivering results for investors. We hold every manager to the same high standards, no matter where they are in the world. To ensure these high standards, we have a comprehensive evaluation process. This includes quantitative analysis, manager visits, and an extensive due diligence process. Next is exclusivity. We have exclusivity with our managers, and these mandates can only be accessed through Curate. Why is this important for you? This means that for you and your clients, you get to come to one place to access some of the best investment managers from around the world, managing some of the best funds in the country. Lastly, we promise to bring you relevant and appropriate solutions to enhance your advisory services. When we launched Curate, we went and asked financial advisors what their clients' needs were, and 3 things came up: an income need, capital growth need, and global diversification. That is what we've launched with in our current range of funds. As we expand, we will offer a range of local and international funds, ensuring investors have access to all the necessary strategies in one place. Our expansion plans are ambitious but yet carefully planned. We aim to cover geographical diversification, economic themes, and introduce a range of innovative products. Now let's talk more about Curate's fund range. Starting with our fixed income range, which includes the Curate Enhanced Yield Fund, the Curate Flexible Income Fund, and the Curate Income Plus Fund. These funds are managed by Momentum's fixed income team. Our capital growth range consists of 3 funds that focus on medium to long-term capital growth. These are the Curate Balance Fund, managed by Visio Fund Management, the Curate Equity Fund, managed by Laurium Capital, and the Curate Flexible Property Fund, managed by a specialist property manager, Sesfikile Capital. Our global range consists of our 2 enhanced index equity funds from Robeco, the Curate Global Sustainable Equity Fund, and the Curate Global Emerging Markets Equity Fund. Our 3 style-specific global equity funds, namely Curate Global Value Fund, managed by Lyrical Asset Management from New York, Curate Global Growth Equity Fund, managed by Jennison Associates from Boston, and Curate Global Quality Equity Fund, managed by Evenlode, based in Oxford in the United Kingdom. Now let's delve deeper into each fund. As mentioned earlier, our 3 income funds are managed by the Momentum Fixed Income team. This team manages close to 80 billion in assets already. The funds are managed to outperform cash by various margins, depending on the fund chosen. These funds also continue to deliver reliable inflation-beating performance. As at the end of last year, each fund outperformed inflation by 2.4%, 3.9%, and 3.6% respectively. The Enhanced Yield Fund aims to outperform cash by 0.5%. It has successfully outperformed this benchmark as well as its peer group over the showcase periods, despite the falling interest rate environment. It has done so by increasing exposure to fixed-rate instruments to lock in higher yields. The Flexible Income Fund managed to outperform cash by 1.5%. It also continues to outperform its benchmark and peer group over the showcase periods. It is currently positioned to take advantage of inflation-linked bonds as inflation bottoms, which are expected to provide attractive medium-term returns. Next up, the Income Plus Fund. This is an exciting fund that is very popular due to the diversification and stability it offers to the income portion of a portfolio. The graph shows the frequency of monthly returns over the last 10 years. The Income Plus Fund has only delivered 2 months of negative returns in the last 10 years, emphasizing its stable return profile. It is very different from other funds in its ASISA category, and being one of only a few pure credit funds in that peer group, this makes the Income Plus Fund a great diversifier to your portfolio. The capital growth range consists of 3 funds that focus on medium to long-term capital growth. Our Regulation 28 compliant asset allocation fund, the Curate Momentum Balance Fund, is managed by Visio Fund Management. Balance funds play a crucial role in investment portfolios, particularly for retirement savings. The appeal of a balance fund lies in its ability to invest across multiple asset classes: equities, bonds, property, and cash, both locally and globally. This flexibility allows the fund to participate in market upside while actively managing the downside risk. Visio's seasoned investment management team recently earned the Best SA Multi-Asset Fund title at the Raging Bull Awards 2025. They boast 256 years of combined expertise across diverse market cycles and asset classes. Visio takes an active approach to investment management, engaging directly with the management team to unlock shareholder value. They scrutinize all information, leaving no stone unturned when vetting investment opportunities. While Visio's approach is predominantly bottom-up, they incorporate a macro overlay to ensure alignment with broader market trends. Key themes currently shaping their investment decisions include global energy transition, urbanization, the continued shift towards e-commerce and digital services, and the accelerating adoption of AI and automation. Next, the Curate Momentum Flexible Property Fund. This fund is managed by Sesfikile Capital and holds both local and global exposure. This allows the fund to take advantage of a broader opportunity set than what would be available if it was only local. One example includes an overweight position to apartments in Germany, as there may be a reduction in rental control regulations. The Curate Equity Fund, similar to the Property Fund, the Curate Momentum Equity Fund has local and global exposure in the fund. Currently, this split is about 62% local and 34% global. The fund is managed by Laurium Capital. Laurium is predominantly a fundamental bottom-up investor, but do also apply a macro overlay. This stems from the acknowledgement that companies and industries don't operate in a vacuum. This overlay helps them get a sense of the macro outlook over the short to medium term for certain industries and geographies. Moving to our international funds, Robeco manages the Curate Global Sustainable Equity Fund and the Curate Global Emerging Markets Equity Fund, using a data-driven approach to outperform their respective benchmarks at a low cost. The key difference being that the Sustainable Equity Fund has specific sustainability metrics that it targets and invests in developed markets, while the Emerging Markets Fund is for investors wanting exposure to the emerging market equities. Rounding out our international range of funds are 3 actively managed style-specific solutions. The Curate Global Quality Equity Fund, managed by Evenlode in the UK. Evenlode looks to identify exceptional companies with strong competitive advantages that will persist into the future. They focus on businesses that keep costs low, invest in growth, emphasize sustainability, operate in growing industries, offer fair value, and maintain stability to protect investors. The Curate Global Value Equity Fund is managed by New York-based Lyrical Asset Management. Lyrical carefully analyzes only the cheapest 20% of shares across the world to find what they call the gems amid the junk. They do this by finding good quality, easy to understand companies that are trading at good prices. And finally, we have the Curate Global Growth Equity Fund, managed by Jennison Associates in Boston. Jennison focuses on finding innovative, industry-disrupting companies with strong competitive advantages and high-demand products to drive growth. They don't follow a strict buy-and-hold approach to investing and believe holdings must earn their place in the portfolio every single day. So why Curate? As displayed, Curate has a comprehensive fund range that complements the solutions available to you in the industry currently. There's a strong focus on providing the market with an advice-driven proposition that meets clients' needs, and a product range that is simple and relevant to assist in building long-term wealth for your clients. Furthermore, we handpick independent single managers with their own investment philosophies and differentiated ideas. And lastly, Curate is excited to introduce new global managers to the South African market for the very first time. In closing, we're committed to partnering with you. At Curate, we believe that we're in the industry of trust. Your clients trust you, and you in turn trust us. Together, we will assist your clients to build that long-term success. For more information on Curate or any of our funds, please reach out to the fund specialist in your region. We look forward to partnering with you as Curate Investments continues to grow. Thank you for your time. Thank you very much.
Thank you, Ray, for those valuable insights. Now let's welcome Flobela Yates, or Fluff as most of you know her, Managing Director at Equilibrium Investment Management. Fluff will guide us through home bias in portfolios and demonstrate how to think global but act rational. Because when we can remove bias from our investment strategy, we can move our portfolios from good to great. Fluff, the screen is yours.
Thanks, Sonia. Hello, everyone. I'm Flobela Yates, but most of you know me as Fluff. As an investment manager, we spend a great deal of time analyzing markets in order to understand the effects of different market cycles and the impact they have on investors. More recently, we've also begun to analyze the impact of investor behavior on potential outcomes. And today I'm going to try and show you how one of these behaviors could impact your portfolio construction and potential outcomes. In this 1939 study, Sigler tried to determine how to maximize nutrition at the lowest possible cost and came up with this basket of goods. Whilst this may have represented the outcome of his findings, I'm sure you'll all agree that combining these isn't really going to make the most appealing meal. If we plot this on a graph to show the relationship between nutritional value and cost, we get an upward sloping line, which we in investment terms refer to as a good example of mean variance optimization. The study then found that by adding in other ingredients like butter and sugar, which weren't the most nutritional and not the cheapest ingredients, made it more palatable for people. And then the combination of ingredients became more palatable. People could actually make a meal out of these ingredients. In other words, incorporating people's emotional preferences moves the line on the graph lower to a different efficiency curve. From an investment perspective, we find a similar relationship between the most optimal investment portfolio and a portfolio consisting of things that people relate better to and might make it easier for them to stay invested. For example, people might be more keen to stay invested in portfolios that include factors such as ESG or crypto and actually tolerate greater volatility or even lower returns in exchange for getting greater access to things that they believe are important. As investment managers, we know that keeping our clients invested has the biggest impact on them getting to their investment goals. So it's important that we don't merely focus on building the most efficient portfolios by plotting them on the efficiency curve, but take these factors into account when building portfolios. And our clients are increasingly telling us that they want to invest in portfolios that are aligned to their values. They don't want to look back and have regrets, and so it's important for us to understand them better. Most clients look at their wealth in buckets. They have a bucket for retirement, holiday funding, emergencies, and the like. And investors want to see their values represented in their portfolios, whether it be ESG factors or biases to things like locally produced goods. One of the biases that we see is the home country bias, which basically infers that people overinvest in local stocks relative to the optimal portfolio. And by the way of example, this is true not only in South African investors, but investors around the globe. From a South African perspective, let's look at the contribution that some of the largest economies make to both GDP and the world stock markets. What stands out the most is that the USA makes up 24.32% of global GDP and contributes about 58% to world stock markets. China, on the other hand, comprises 14.8% of world GDP, but only contributes to 4% of the global stock market returns. International portfolio construction can best be explained as a mixture of rational and irrational behavioral factors. When it comes to behavioral science, we rely heavily on the work done by Paul Nixon within Momentum Investments. And through his research, I came across some research done by Dr. Giselle Willows and one of her students, Sheena Jagnandan, who did a thesis on the disconnect between where South Africans want to live and where they want to invest. Through their research, they found evidence of home biases where a large portion of assets remain onshore. Apart from it being disproportionate to South Africa's contribution to world GDP, it also reduces the diversification benefits in portfolios. The research shows that there are a couple of reasons why we see home country biases in portfolios. They range from hedging home risks, barriers to foreign investments, information asymmetries, risk aversion, corporate governance and transparency, and then, of course, behavioral factors. So let's look at some of these behavioral biases. The first is the familiarity bias. People who express this behavioral factor tend to invest in stocks that they are familiar with. An example is them believing that because they use a specific brand, it must be popular to others. And so they are more likely to invest in companies whose brands they like and use. The second is availability bias. They will buy more South African equities because they believe that because they live in South Africa, they tend to have more control or influence over how South African companies perform. Some may even go further by investing a proportional amount in shares of the company or group of companies that they work for. But what happens when performance of the economy or the company is influenced by factors outside of their control? Not only are their salary increases and bonuses, or lack thereof, affected, But I'm sure you can see how the lack of diversification in both the above scenarios could also affect their portfolio returns, and this could be detrimental to some of their shorter-term buckets. Again, this isn't a South African specific problem. I'm sure we all remember what happened to Silicon Valley Bank. Employees who'd been given stock options as part of their remuneration lost not only their jobs, but also big portions of their net wealth when the bank closed down. Then there are cultural biases and other strong beliefs based on the environment in which investors grew up, their personal experiences, and what they believe to be true around the world power, governments, safety of certain asset classes, currency risk, and access to their investments from domiciles outside their home country that often also affect how they invest their money. And of course, the vehicle through which you invest may also place further limitations on whether you are able to invest in other domiciles. For example, model portfolios can only invest in underlying collective investment schemes, or more commonly known as unit trusts. The availability of feeder funds into offshore solutions is limited, and particularly when you are investing across multiple platforms. Regardless of what the biases are or why they exist, our challenge as investment managers is to help people avoid behavioral biases by putting together optimal portfolios which represent weights in other countries and not just the home country in which they live. When we construct portfolios, we look not only at the return expectations, but also spend time understanding the risks associated with certain geographies, as well as how asset classes and funds behave in various market conditions. And then only do we build robust and diversified portfolios that make it easier for investors to stay invested through time. This requires a deep understanding of financial drivers, different asset classes, various investment styles, and also what risk means for different investors. And yes, an understanding of what triggers certain behaviors in certain investors. I could spend all day talking about that alone, but today I'm going to focus on the impact of home country biases. We recently did an analysis on the model portfolios managed on behalf of South African investors on local platforms. The information is limited as we have to rely on publicly available information for some of our competitors, but the results were astounding. Of the 67 balanced model portfolios we looked at, just over 43% had no exposure outside of South Africa, and only 10% had 45% or more invested outside of SA. The performance differentials between these portfolios ranged enormously, and without detailed information around all of the underlying holdings, it's difficult to make further conclusions, but it's clear that the volatility will be vastly different without the benefits of full geographical diversification. We have a team based in the UK that manages hard currency portfolios for South African and UK investors, and so I thought it would be interesting to see whether there's any difference between the two ranges in terms of home country bias. But we found similar biases exist there. And since I do have the look-through information for these, I was able to gather much better insights. As you can see, the equilibrium models have a more neutral allocation to the MSCI World Index, whilst the momentum models have a bias towards the UK. And the effect on performance in US dollars is evident. The models with a UK bias significantly underperformed those with a more neutral weighting to regions over the 1, 3, and 5 years. And when we look deeper, it's not actually only the US allocation that drove this. Obviously, that was a contributor over the more recent period. But our managers were actually underweight the mega tech stocks in the US in both of the ranges. We also followed the same philosophy and had similar asset class and style diversification in both ranges. But what the biggest impact on portfolios was the diversification across countries and the sectors available in different economies that actually contributed significantly to the differences in performance. We have loads of analysis that we could use to show the effect of home country bias on both local and global portfolios, and also how this changes through time. But given that our time is limited, I want to leave you with one last thought. Investor biases exist, and matching liabilities to where they arise from is important. But if you really want to use all the levers at your disposal, you need to construct portfolios that take these into account, but optimize for the best outcomes over various time horizons based on each investor's preferences. Thank you for your time.
Thank you, Fluff, for that thoughtful perspective. Finally, let's turn to Faria Adam, CEO of Structured Products and Annuities, who will discuss how to optimize your clients' personal life annuity profiles. Understanding income now and in future is key to your investment success, and we all need a guide to show us the way. Welcome, Faria. We're ready to learn.
Thank you, Sonia. Hello, everyone. Our economic environment is changing, and recently we've seen decreases in interest rates, often with positive benefits for the economy and our personal budgets. The consequences on long-term yields is another factor to consider because it directly affects the guaranteed income that a retiring client is able to lock into. So today, I want to share some insights into the yields offered by guaranteed annuities. I'm going to talk a little bit about how to evaluate the increase rate on an annuity and spend some time on how to determine the minimum guarantee term for a client. Lastly, I will give a view on the Capital Protector product and its inheritance value. Now, the graph you see on the screen is based on Bloomberg data and shows that for the period from June 2023 to June 2024, long-term yields were consistently above 11.5%, even in fact reaching 13%. However, since June 2024, there has been a downward trend, and we are currently seeing rates between 10.5% and 11%. The drop in yields really looks quite extreme when you zoom into it. You can see that my scale only starts at 8%. But on a normal scale that starts at 0, it definitely looks less extreme. And we can see that despite the drop, long-term yields remain relatively high. So how has this reduction affected the income from guaranteed annuities and the value proposition to your clients? This next graph starts at June 2024, so it captures the period where yields decreased. We are looking at the annual income in year 1 expressed as a percentage of the purchase price of the life annuity. Now, in this example, the client is 60 years old and purchasing the life annuity with 1 million rands. The red lines assume the client is male, and the blue lines are for females. Now, in general, females are expected to live longer, so the income to a female is a little less than that for a male of the same age. As expected, the graph has a downward shape between June and September, but since then, it has really been reasonably flat. The level income to a client has been roughly consistent around 11%, which is shown by the solid lines, while the starting annual income on an annuity that increases at 5% every year is between 7% and 8%. When evaluating these options, it's critical to consider your client's future income profile, especially because the annuity profile that you choose stays fixed for the rest of the client's life. For an increasing annuity in our previous example, although the income in year 1 is around 7% of the purchase price, by the time this client reaches age 80, he can expect to receive 20% of the purchase price in annual income, which will help to protect the purchasing power over time. So how can you assess what is the best increase option for a client? We are going to discuss this based on 3 different scenarios. Firstly, a level income, then an income increasing at 5% every year, and lastly, an income increasing at 7% every year. If we project the starting income, we can see that for the first 5 years, a level income offers the highest income for the client, indicated by the red font. At around 10 years, a 5% increase is best. But from 15 years onwards, the highest increase, being the 7% income, is the highest proposition. But that is just the nominal value.
Looking at the real value of income is important for a client to understand his purchasing power. So let's look at the first column. We can see that the real value, assuming inflation of 6% every year, eats into the income. So much so that by the time this client is 75 years old or 15 years later, the real value of his income is less than half what it was at the start. The 5% income protects value significantly. Over time, the real value does drop because the increase isn't sufficient to counter the effects of inflation, but the change is much smaller than what we see on the level income. The 7% scenario in this case is the most likely to counter the effects of inflation, and over time, both the nominal and the real value of the income increase. So the important points to consider are: looking at future projected income is critical in determining the income escalation rate your client might need. Secondly, always consider the real value of a client's future income and aim for an increase rate of at least inflation. But future inflation is impossible to predict, especially over the long terms that we're considering here. So choose the highest increase that a client can afford. The best option for a client is a CPI-linked annuity. If inflation is low, the increases will also be lower. But when inflation is high, the real value of the income will be completely protected. Currently, the pricing of CPI-linked annuities are very close to a 6% guaranteed increase. So if your clients can afford the 6% increase, also consider a CPI-linked annuity. Now, another question that many clients likely ask you is, but how much money will I get back? With a life annuity, you don't know how long the income will be paid because it depends on how long the client lives. In general, the longer you live, the more utility you get from the product. But no one wants to take a chance of not getting their capital amount back, and this is where the guarantee term comes into play. In general, adding a guarantee term does not significantly reduce the starting income, but for clients who haven't saved enough money, even a small amount can make a big difference. So how can you determine the minimum guarantee term that a client should have? One way is to look at the total amount that a client is expected to receive if he lives for different periods. The red font shows which scenario offers the highest total amount over the period being considered. So we can see that if a client is prioritizing a term of 10 years, then the level income scenario offers the best value. Over 15 years, it would be a 5% increasing scenario. And longer than that, it's the 7% increase. The graphs present this a little differently. The dotted line represents the purchase amount. And you can see that over a 5-year term, none of the accumulated incomes reach the purchase amount. So this term is too short. A level income, the red bar, with a 10-year guarantee term would ensure that the client at least receives his capital back from the product. A 7% increase, the orange bars, with a 10-year guarantee term clearly does not give this guarantee. So the minimum guarantee term that such a client should consider is 10 years with a level income and somewhere between 10 and 15 years with an increasing income. In the near future, Momentum will be making these types of illustrations available on our online quote system so that you can easily show your clients the effects of different increase rates and guarantee terms. Another proposition that I want to talk about is the Momentum Capital Protector. This package combines a life annuity with a life cover product that does not require any underwriting. So the client pays a lump sum, he receives a regular income stream for the rest of his life, a premium is deducted from each income, and there is a lump sum payment to the beneficiaries when the client passes away. If we ignore the effects of tax, current pricing offers clients an income of 10.6% of the purchase amount before the premium and 8.9% after the premium, assuming a level income. But we've seen that we also have to consider increasing income, and in this case, the corresponding numbers are 7% and 6% respectively. Now, typically, people use their retirement savings to purchase either a living annuity, a life annuity, or capital protector. But remember that the capital protector is just a special case of a life annuity. So this next table compares the inheritance value of these propositions. The value paid out of a living annuity can be more or less than the original amount invested, depending on the drawdown rate and the investment returns that were achieved. Beneficiaries can choose to take the benefit as a lump sum or as an income, but in both of these cases, there will be tax payable. On a guaranteed life annuity, the amount paid out depends on how much of the guarantee term is remaining. So over time, the value decreases. This amount can also be taken either as a lump sum or in income, but both will be taxed. The death value of a capital protector is, however, always a fixed amount, paid to beneficiaries and a lump sum. And very importantly, it does not attract any tax. Therefore, it offers the greatest certainty of inheritance value. Everyone reaching retirement age should consider a guaranteed annuity for their fixed life expenses. As I have illustrated, the value proposition remains very attractive. Choosing an appropriate increase rate to counter the effects of inflation and a suitable guarantee term so that clients are assured about the value they receive are important factors. The inheritance benefits of using the capital protector must be considered. The profile of a life annuity can provide a very valuable diversification benefit when combined with market-linked assets in a living annuity. Momentum offers this unique hybrid proposition to help balance flexibility and certainty for your clients. Thank you for your time. I hope these insights help you to offer personalized certainty for each of your clients.
Thank you, Faria. Next up is Fadi with some closing thoughts.
What an incredible session we have had today. It's been truly inspiring to hear from our executive team, each of them bringing their unique insights and expertise to the table. I hope all of you found the discussions as enriching and thought-provoking as I did. Let's take a moment to reflect on the key messages shared by them. Imna began with an insightful talk about the transformative role of technology in wealth management. She emphasized how platform providers like us are partnering with advisors and investing capital to stay ahead in the technology race. These advancements can directly benefit advisors, enhancing their ability, so your ability, to grow and retain your client base. Next, of course, Ray introduced Curate Investments, the latest asset manager on the block, as said by the Business Day. Curate Investments aims to simplify the complex world of investing by collaborating with leading asset managers globally. Each unit trust fund is managed by a handpicked team of highly skilled professionals, ensuring top-tier investment opportunities that offer diversification, long-term capital growth, and income generation. Be sure to check them out on the website if you have not done so already. Flof then delved deeper into the impact of home country buyers on investment portfolios. She shared insights about how over-investing in local stocks can lead to suboptimal diversification, driven by behavior biases such as familiarity and availability. The significant performance differences between portfolios with and without home country buyers underscored the necessity of geographical diversification. The conclusion was clear. Investment managers must balance investor preferences with optimal diversification to achieve the best outcomes over various time horizons. And then finally, Faria spoke to us on evaluating the income from a life annuity. She explained how changing long-term yields over the past year have impacted life annuity income and how attractive income goals can still be achieved. The importance of inflation protection through increasing annuities was highlighted, along with strategies for evaluating guaranteed terms specifically on accumulated income, and then provided a perspective to us on the capital preservation option proposition, which ensures a guaranteed drawdown rate that protects the capital amount. As we conclude this webinar, I want to extend my gratitude to each of our speakers for their valuable contributions. Your insights have provided us with a wealth of knowledge and a deeper understanding of the dynamic landscape of investments. To you, all our attendees, thank you for your online participation and engagement. Your presence and interest are what make events like this truly successful. We appreciate your time and commitment to staying informed and connected with Momentum Investments. Let's continue to work together, leveraging the insights shared today to drive forward the mission to build and protect our clients' financial dreams. Thank you once again, and I look forward to your continued collaboration and success.
Thank you, Patty. And just like that, we've reached the end of this edition of Wealth Matters. Thank you for sharing your valuable time with us. We hope you found today's session insightful and that it sparked new ideas. Remember that when AI, technology, and humanity work together, the possibilities are limitless. But no matter how good the technology gets, there really is no substitute for human interaction and empathy. It's been a real pleasure to be here with you. Hopefully I get to do this again with you. And hey, maybe next time I'll get a digital upgrade. Fingers crossed. Until next time, take care and goodbye.